Hey everyone, welcome back. Happy Tuesday. Hope you guys are having an awesome day. It is July 2nd. Happy Canada Day to all of my Canadian subscribers. Yesterday, had a beautiful day off with my family. We had a camping long weekend. It was kind of great. We drank too much beer, had too much sun, sat around the campfire, ate too much, and it was fantastic. I see Kevin's joining from Lakeland, Florida. Happy to always have you here, Kevin. I see there's 5 people on live. Let me know where you're watching from and what we can take a look at today. I would love to know what stocks you guys want to look at. Tell me about your long weekend plans too. Where are you going? What are you doing? I know that we've got 4th of July coming up later this week on Thursday. So we've got a little bit of a break in the holiday, or like a little shortened holiday week this week, which has been good for the market overall. Typically the market rises in the first week of July, first week and a bit. Reading some interesting stats about that. It's one of the few periods of the year where we have like consistent gains in the first half of the month, year over year. So on average, oftentimes if you look at data over a longer period of time, you see that most periods of time actually average around zero. We have some years where the market goes up and some years where the market goes down. But the beginning of July tends to be a slightly bullish sentiment in general. It is a little bit of an anomaly. So not surprised that the market is close to all-time highs right now. We're going to get into this. I see Terry's joining from Claresholm, Alberta. Adam's watching from Ottawa, and Neil's spending the 4th up at our vacation cottage. That sounds fantastic. I love this time of year where we can just get out of the house and get away from our computers a little bit, which is part of the reason why I do the style of trading that I do. You know, I do have a little 0 DTE trade on, so like a 1 DTE trade. It's been working quite successfully, but I don't do a huge amount of 1 or 0 DTE trading in general because I find it pretty stressful and I don't want to just be glued to the screen for 6 hours. I like to be able to take the time during my day to spend time with you guys, answer questions, work on my Patreon group. So remember, that brings me to my disclaimer. We not financial advice in any way, shape, or form. What I discuss here is just potential trade ideas that I'm looking at, what we may or may not take in the future. But I do have a Patreon group as well where I post all of my trade ideas. So these are my live trades. I post them there and it's open discussion. So it's a fantastic community. If you don't sign up for the free newsletter, or if you haven't yet, go over to patreon.com/drawbridgefinance and sign up for the newsletter. It is free and you get notifications when I do these live streams, which are Tuesdays. And then obviously we do the members only live streams on Thursdays. So that's my sales pitch for the morning to start this off. And let's get into some trade ideas. I've got Jimmy Traders watching from Prairie Sound. Mike Mueller says hi, and Mike Mueller says my token Black Swan head question. Great, I love a good question right out of the gate. When putting these on, you're mostly hedging Vega and not so much Delta, right? It's that sudden drop that you're trying to cover. That's correct. So once the Black Swan hedge is put on, like once it's in stage 2, because there's more long than short. If the market was to have a catastrophic failure. Now, when you look historically, like even in October of 1987, we didn't see massive drops in a single day. I'm trying to recall off the top of my head. In 87, by the end of the year, we were down like 20% on the market. The beginning half of the year, we were up 10%. So we had like a 30% drop from October to December. This is one of the biggest drops that we've had in history, and aside from 1931. So we had 31.87. Those are the 2 biggest ones. They took about 2 to 3 months to get that full drawdown. The Black Swan hedge protects against those. Now, we're never going to see, or it never has in our lifetimes or the history of the stock market, seen a drop that is big enough to trigger these in a single day. So they are a multi-layered strategy. And that's why I have them layered on the way that I do. So when I'm looking at that Black Swan hedge, I'm looking for that 30% drawdown. As that happens, if it were to occur, then the volatility is going to increase dramatically. It's the volatility increase or the Vega increase that is pumping up in those positions. So when we look at the profit loss curve in our portfolio, if we have enough hedges on, we actually get a curve. Am I drawing this to the right side? Yeah, to the downside, we actually have a curve that like goes up. So it is taking care of some of that volatility. That's what we're trying to reduce, is some volatility. The base strategy for most option sellers is to have a little bit of a profit tent to the downside anyways. That's why there's so many people that trade like 112s, or they trade out of the money short puts. They play something that has a little bit of a downside. I went the wrong way. A little bit of a downside in the market. Those two things work in conjunction. So the black swan hedge will help reduce the volatility that we're experiencing in the 112 trades. And in a massive drawdown would actually pump the account up if we've got enough on. Okay, let's jump into what we're looking at today. I'm gonna jump over to this screen right here. Market is screaming upwards. This is on the right-hand side of the screen, you'll see S&P 500, there's a 1-minute chart. There's a 15-minute chart. On this side, we've got NASDAQ, 1 minute, 39 minutes. So we can see the kind of what has been occurring today on this 1-minute chart. We'll focus on this for a moment. And we can see we've been traded down a little bit this morning, traded some flat consolidation, and now we're starting to see this creeping back up. Outside of the standard deviation bands off the VWAP, most of the volume down as expected, where we were trading here in this lower range around on the SPY around 545, marking rate around 545. That's kind of where the point of control is at this point in time. So this is on the daily chart. SPX up 0.38%, NQ up 0.83%. So we're getting back closer to these all-time highs. IWM down are up 0.14%, and Dow Jones Industrial average 0.17. VIX coming down, marking under 12. So we're seeing under a 12% volatility index at this point in time. Complacency in the market, expectation that we're going to continue to see bullish action over the course of the year. It's pretty typical that when we see a market that has risen at least 10% in the first half of the year, that we see a continuation of that, especially when we're in an election year. There's very rarely do we have an election year where there is a down year. So we'll see. I was having a conversation this morning with my stepfather about whether or not we have is the election going to be a major event? I really don't think that it's going to. I think the US economy is not in a great situation. We know that it's not. Interest rates are high, inflation is high, but I don't think that the election of either president, whoever wins in the US, is really going to dictate the market in one way or another. I think that there's major economic events that are driving this underlying movement in the market, and I don't expect, it doesn't matter what the outcome is, in my opinion only, it doesn't matter what the outcome is, it's going to be positive for the stock market. And my expectation is we're going to see this continued stock market bullishness over the next couple of years. More than happy to discuss that. So if you guys disagree with me, let me know. What do you think? Is the market going to go up or down over the next 3 years? Let's maybe that's the question. In the next 3-year time frame, up or down, comment in YouTube so we can see kind of how many people agree or disagree. John Lindsay's tuning in from Oregon, and Marius is he's asking, what strategies are you often performing in your portfolio? Is there any that you did for a long time and that aren't working good? Yeah, so the strategies, I prefer to have a ton of strategies. If we were to look, let me pull up my rolling options record keeper here, and we'll go to a new trade. And I know you can't see it yet, but I'll pull it up for you guys in just 1 second, and then I'll show you kind of how my sheet works, because it makes a little bit of sense. So if we were to, okay. So down here at the bottom, if I was to look at a blank sheet in the rolling options record keeper, normally if I was starting a new trade, what I would do is I would just duplicate the sheet. And this gives me a copy. And I say I want to take a position in a stock. Let's take a look at Apple. I have this open right now. So we're looking at the Apple chart. We're looking at what we think might happen. What we can do is we can say here, the valuation is high. It's F valuation, but it is a profitable company. Its momentum is quite good. It's rated 7 out of 10 right now on Seeking Alpha. It's definitely in a bullish trend. But I may not want to buy this for $219. I may think that this might drop down. Let's look at the expected range of Apple and see if we can put on some sort of trade. I'll show you how my rolling options record keeper works in this way. So if we were to look out, like say a month, I'm looking down at this level, this 193. I'm looking at the expected move in Apple and saying, okay, well, Apple was trading down here around 207. I think it's going to stay above 210. We're going to see some continued bullishness in this. What kind of trade can I put on that makes some money above this 210 level, which seems like a decent level that I might want to buy at? So that would be my first consideration. Drew that a little bit high, but it's saying I don't mind going long if Apple trades above 210. If I want to take a very basic strategy, this is options AI. You can just look at bullish strategies. A credit put spread might be something that you might consider. My rolling options record keeper gives us way more choices than that. So first of all, what I would do is I would just type in Apple here, put it in all caps. What that's going to do is it's automatically going to pull the share price. Then I'm going to put in my transaction date today, and it just fills down the column. So my underlying price right now is going to be 219.88, which is the current price. This cell D7 is always going to update with the current price. I'm just recording it as if I was opening the trade today. Now I can record any sort of notes, or typically the 52-week implied volatility rank. It gets recorded in this cell, but really this is row 10 is just made for notes, so we can put whatever notes we want in there. Number of shares owned, if I have some, I would be able to chart it in the profit loss chart if I was to put this down here. For example, I could just put in 100 shares, and even if I did this for a zero credit, you would see that this is what my profit loss chart would look like if I owned 100 shares. So we can include the shares or not in the rolling options record keeper. I'm going to take those out for now. And now this is what I'm trying to get to is, what strategies do I typically take? So here's the list of strategies that are fairly typical for me to take. We've got really basic strategies like a 111. We've got a Batman, which is like a complex iron condor trade. We've got a Batman with unlimited loss, which is kind of a complex ratio spread based on a strangle. We've got a big lizard, which is a bullish trade to the upside, similar to a jade lizard, but with the short puts at the same strikes. We've got a butterfly. We can do puts or calls, broken wing or unbroken, depending on what we want. We could just do a simple buy stocks and write the covered call against it. We could do a call butterfly. We could do a call calendar, call spread. So the call spread is one of the things that we see on on options AI. If we look over here, call spread, it's pretty typical. So if I wanted to enter one of those, I would just choose that from the drop down. What my record keeper does is it actually, when I choose the call spread, it highlights the positions that I need to put in. We're selling a short call and we're buying a long call. And we have an expiration date. So it automatically highlights the cells that are required to complete the strategy. And it does this with all of these different strategies. So if you're learning strategies and you're trying to figure out, like, what could I do? I'm bullish on Apple. I don't want to buy if it's too low, but I want to put it, but I know the volatility is low. I might want to take like a humpback trade. Well, what is that? A humpback is a pretty simple trade. It's a short put, it's a short call with a near-term expiration, and it's got a later expiration date with a long call. Let's take a look at IBKR and see if we can set up a humpback trade that would allow us to potentially profit, and how it charts out here in the rolling options record keeper. These are the type of trades that I might put on. So here we go, understand and accept that. We'll zip over to the watch list. We're gonna look at Apple. And, typically with these types of trades, I'm going out about 45 days. The volatility is low. So what I'm saying is I don't mind buying Apple if we were to, if it was to drop below 210. So I'm gonna sell the 210 put. That is going to give me a credit of $300. The profit profile on this is a flat line. Very, very simple trading style. If Apple stays above 210, I collect this $300 and I get to keep it at expiration on August 16th if Apple is above 210. If I wanted to make this a slightly more complex trade and I thought that Apple was actually going to go up, what I could do is I could sell the 235. Now, this is a strategy that most people should recognize if you're an options trader. It's one of the basic neutral strategies where we have a short put and a short call. 67% probability of profit. And so this is called a short strangle, where we're selling a naked put, we're selling a naked call. We have no stock position in this. If I want to turn this into a humpback, what I could do is I could go out to a later date. I could say go out to January, and I could buy a call above this. And what this does is it creates a profit profile that is slightly more bullish in nature, because what I'm creating in here is a diagonal. I've got the August 16th 235 call that's short, and I've got to buy the sell the August 16th 235 call, buy the January 17th 250 call. This creates a diagonal spread. Without the short put in there, this is what the position looks like. It's looking for a bullish move to the upside, but it does have risk to the upside as well if Apple was to go up too much. So it's a relatively neutral trade with a profit spike very specifically at August 16th around the 235. Why might we put that on? Well, let's go over to Options AI and take a look at where that is. If we look at, let's look at the 3-month chart, and the August 16th, 233.25. This is the potential expected move. So when we look at the profitability range of that humpback and we look at where the expected move is, it should correlate to what the market is actually pricing in. In this case, we have $206 to the downside, $233 to the upside. So let's take a look at that humpback position and see where those break-evens are. Break-even on this trade just by itself, the diagonal is 216, 246. So it's relatively high in comparison to that range. It's a very bullish trade. By adding that short put in back on the August 16th date, by selling that 210 put, we're creating a flatter profit profile. We're bringing this break even down to the downside, and we're bringing the break even on the put side down. So now we have break evens between 208 and 253. Let's take a look at where that is on Options AI. So 208 would be like right here, and then 253 is going to be off this chart. You know, it's going to be up here somewhere. This is 220, 240, 253. It'll be approximately here. So that's the profitable range. And I like these types of trades when I expect some sort of IV expansion. I might do this. You'll notice in Options AI, one thing that I haven't mentioned is that there's a little bit of a blip here in the expansion of the projected cone price-wise. This means we're going to have earnings coming up. Typically, if I'm doing this type of trade, I wouldn't do a trade that includes a diagonal to be held over earnings, because my short option is going to decay very quickly. My long option is going to have some decay as well. The primary moneymaker in a diagonal in the long term is the actual value of the long position. So I don't play them typically through earnings. I might play it up to earnings. So from a standpoint of like what trades do I often trade, it really depends on IV, but in low IV, I am playing quite a few like call calendars, diagonals. I don't play a ton of double diagonals. That's not really something that I do. I have been playing some, like a Marauder would be a good one because it has a diagonal. Poor man's covered calls are always good if we're bullish. Lots of butterflies right now, just because we're in such low IV. If there was an IV expansion event, I want to have limited loss. So put butterflies, call butterflies. A Rampart is also another good one. It includes a diagonal. Not playing a ton of the unicorns right now. The IV has actually dropped so much that they're not that great. We're just not getting enough on the short duration puts and calls. Unicorns a call trade. But we're not getting enough on the short duration theta to warrant having a unicorn trade on. Haven't been playing the Vikings at all. Call zebras, I definitely am loving call zebras right now. If I'm bullish on a stock, this is like one of my go-to trades rather than buying stock. Now I've been stock trading for almost 30 years and I am holding less and less stocks. If I want a bullish position, I just take a call zebra. So that is kind of how I'm functioning in general right now. Let's see what else. Terry, so my second complex trade, Starbucks, July 19th, 71.73, 81.83 Iron Condor. Thoughts, please. I think my credit was 35 cents. So typically with Iron Condors, I am looking for about 1/3 the 1/3 of the credit, 1/3 of the width in credit received. So if I was to look at like Starbucks, which does have low credit because it hasn't been moving all that much. If I wanted to do a neutral strategy, looking out at July 19th, 17 days, we've got this is what Options AI is pulling up. It's the 74.73. So they're looking at $1 wide, and then the 79.80. Pretty aggressive. The reason for this is because Options AI is looking for this probability of profit that's relatively high, and they want to make sure that this risk reward ratio is appropriate. Typically, we want to try to collect about as much as half of what we're risking. So about a 50% per condor. When we start to get into wider positions, you'll see that this the risk that I'm taking becomes greater. So if I was to increase this width to $2, this is still not bad at all. This is the way to do it, where we're increasing the amount of risk that we're taking by widening the wings rather than putting on more contracts. I would rather have less contracts and wider wings than more contracts with tighter wings. That's just my personal preference. And the ratio here is still pretty good. We got a 75% pop, 62% gain, or $62 gain at a risk of $138. Now this isn't quite what you have. You've got the 81.83. So let me just do all of this here. And you've got the 71.73. So we've got to go one step wider. Oops. Let's go like that. 71.73, 81.83. Are we close? Yeah, there we go. 75% probability of profit. This ratio is a little bit skewed. If we assume that we put on enough of these trades, doing the math on this, if we say we run 1,000 iterations of this, sorry, I'm going to kill that Discord so you guys don't have to hear that. If we put on 1,000 trades and 75% of them were winners, what would be the return on this particular trade? We've got $29 and 171. Let's pull up a calculator here and just do a little bit of math. So on 1,000 trades, 75% of them were winners, and we have $29 profit if we get max winners. So times 750 trades. So we would have profit of 21,000. Just going to write that down here. So we've got 21,750 would be profits from the 75% winning trades. And then the losers, we would be losing, what was it here? We would be losing 171. So the losers would be 171 loss times 250 trades. This would be if I lost 25% of the time. So I would lose 42,000. The math doesn't work in that case. The risk is far too great. What we want with condors is, so this is 42,750. We have to assume that the probabilities are going to play out at some point. So you can see how much we lose. If we took 1,000 trades, we would be down about 21,000. Now let's compare to a tighter spread in here. We'll select all of this and we'll just tighten these up. Go the other way. Let's tighten them. So say we took a more aggressive trade, and we now have $76 gain, $124 risk. Let's do the math again. This is 67% probability of profit. So in this case, on 1,000 trades, I'm going to have 670 wins, and I'm going to have 330 losses. So the 670 wins times 760, so I'm just going to do it here. 760 times 670 is going to be that math didn't work. $74 times 670 is going to be a profit. We're going to have winning trades that account to a plus 49,580. 49,580. And being slow to type, I'm sorry about that. That's I need like a pen. And then the risk, we're going to have 330 trades that lose 125. So 330 times 125 works out to minus 41,000. So if the probabilities played out in this case, I would be minus 41,250. We have to assume that if we trade enough times, enough instances, we're going to get closer and closer to this probability that happens. And in this case, this math works out. We end up with net positive. So if I put on 1,000 of these trades, I did it, then statistically, I am going to be net positive. That is why I like to be more aggressive with my positions and make sure that I have a fairly high probability of profit, but don't take too much risk on a single position. So in answer to your question, I don't think the risk to reward is great in that particular trade because one loss takes out too many winners. So, but it's a great question. And thank you for sharing those details with us. That's just kind of how my thinking works on those. When I'm looking at high probability, I assume that if I put on a 67% chance of win, that I'm going to win about 67% of the time if I play it often enough, which is the intent. You know, trade small, trade often, right? That's why Tasty Trade functions the way they do. If you are familiar with Tasty Live or Tasty Trade, that's kind of a lot of the metrics function on those things. Let's take a look at John Lindsay. I'm looking at a put credit spread bullish for Dell, 130, 125, out 3 weeks. I'm not surprised. Dell is a big winner right now. We continue to see that upside move. I don't have Dell on my list here, but let's look at the potential of where we are with Dell. Continuing to move up, 141, 130, 125, 3 weeks out. So let's look at the 1 month. 3 weeks is before earnings. Where are we? 3 weeks, the 19th, that's 17 days from now. So we're either looking at the 19th or the 26th, but either of those are in that range. The expected range is above 130. So if we were to put on a bullish trade and we were doing a credit put spread for expiration, either the 19th, which is 17 days, the risk reward pulling up the 130, 132, 37 to 163. This is, again, we have to run the math on every one of these scenarios. I would be taking a bullish trade on Dell. One of the things, this is where I might consider doing something that includes a diagonal. So I might do a trade like a Rampart. So let's take a look at Dell, and I'll show you how I might set up something like this. If I wanted to have a neutral but bullish strategy, then what I can do, and it doesn't always work, but we've got the 125, 130. So buying, selling the 16 delta, buying the 8 delta, that makes sense. And then on the top side, like say I thought that the stock was going to run up, I could actually sell pretty aggressively. I could sell the 152. And then all I have to do to protect this, just go out a little bit further in time and just buy a call. And we'll take a look at what the profit profile looks like. If and again, we have to run our scenarios on whether or not this is profitable or not. It does depend on the fill price. This one with IBKR is always assuming that we're paying a debit of 40 cents for this. The likelihood is that we would be paying either, a mid price around 10-cent debit to open our trade like this. So about $10. So the profit tent will be slightly higher. What we're looking at here are the break-evens, 130 to 157. Do we think it's going to trade in that range? Because if we do, that does have a max return of 324, which is really nice. Instead of making like $60, we have a similar risk to the downside by taking this trade. We've increased that risk by $60 of risk, but we've increased the potential profit up to 324. Now it'd have to be right at the strike, right at the short 152 call, but it does allow for a bullish position that can work quite well. Now, if it runs up too much, obviously that's not great for us. What we could do is just tighten this up and play it as a calendar if we wanted. So by spending a little bit more money, it's going to increase the downside risk, but really make it a bullish trade with a lot of potential. Now it's got $440 in max return. It's got a max loss of 739. It has very little downside risk. If Dell moves up anytime, it almost instantly becomes a profitable trade. It's got a long delta position in this case. So we see that we've got long delta. These are fun and can be very, very lucrative if played the right way, because they are a limited loss strategy. So we have defined risk to whatever side we want, and allows us to play those short strangles and make money on the upside move. So that's kind of the thing I look for. If I'm considering selling a short put spread, then I often look for, can I add a call diagonal or can I add a call calendar spread to that top side to make a little bit more potential profit to the downside, taking a little more risk to the downside. Eric Marshall's August 16th put condor on Mara. Mara is a pretty big mover. August 16th is pretty far out. So July 2nd, let's look at the expected move. There has to be earnings coming up at some point here. I play Mara weekly, so it can move quite a bit. August 16th feels far out to me. We've got an expected move between 1684. So I'm looking down at where is this range, 1684 and 2757. And it looks like there's a little blip in here, which means earnings must be coming up there. Earnings are August 13th. So I definitely would not play Mara Condor this far out if it's an earnings play. I would wait until closer to the earnings, and I would be entering my August 16th positions on the week of August 16th. Playing before that makes more sense. So makes more sense to me. You know, you guys do what you do, but for me, I don't like to go super far out before earnings, because if it goes way up, then I've already potentially lost money. But I could play before the earnings, which are August 9th, and they can be quite lucrative. Like, look at this, max gain $60, max risk $40, 79% probability to profit. Let's run the math on that and see how big the gain is. If we were to do this every 38 days, 78% of the time I made $50, and 22% of the time I lost $50. That's basically risk one to make one. The gains are going to be massively high. So this is one of the reasons why I play Mara on a weekly basis. There is lots and lots of premium in it. We can also play this really short if we want. Like, say we did the July 19th. Again, this is like the perfect setup. And this is why I like using options AI. We've got the 67% probability of profit. The max gain is about half of the max risk. So I only need to win 50% of the time to break even. I say that. No, we have to win 66% of the time. I totally lied to you. 66% of the time we have to win to break even. When we see probability of profit 67, typically the win rate on a condor is about 81% statistically. So that's why we trade them in this way. And it's why programs like Options AI are set up. And this is one of their standard neutral trades, an iron condor or an iron butterfly. For me, I would be definitely looking at playing these shorter durations and have a couple more trades on before that expiration in August, or that earnings in August. Leo, is it a good time to buy Dallas and BCE, which is Bell Mobility? I really don't think so. I was just saying to Kareen this morning, I had a good friend last year. I told him on multiple occasions, boy, I wouldn't be holding TELUS, and he had way too much money in TELUS. And I haven't been a telecom holder for a long time. But these companies, does it even, sorry, I'm not showing my screen. I'm just trying to look up if Options AI obviously doesn't have it. I was trying to see if we can see TELUS on Seeking Alpha, and we can't. But all-time lows today, all-time lows, 52-week lows, something like that. Let's look up TELUS. There we go. It's on the Toronto Stock Exchange. We're down to 3% today, 5-year. Let's look at the 5-year chart. I mean, it just not a good time. These are, this is the type of risk. And, for me, being a more active trader than I was, one of the things that has shifted, I mean, I became a dividend investor in 2003. So that's 21 years ago. I was all in on dividend stocks. One of the things that's happened is these dividends have gotten so low that they don't save the stock price if the company is not doing well. So these companies are not being as profitable. The dividend is not high enough to keep the stock price, to keep investors interested. For me, I've just walked away from all of these types of trades because what's happening is I'm holding the stock and the depreciation of the stock far exceeds the amount that I'm getting from the dividend. Until dividends return above 10%, and I know you guys are thinking, like, who pays 10%? In 2003, I was looking at 13% dividend. So I bought the stock, collected 13% annually. I was able to make money back then. Those dividends had dwindled, and I don't like it. I'm not going to take those stocks anymore. So TELUS, I'm sure, is still profitable, but do I see upside potential in their stock price? No, not to warrant the small dividend that I'm getting, because the dividend isn't big enough to protect from a price drop. So that's what I'm looking at. Easy Money's asking, any thoughts on Adobe? I like Adobe. I pay them every year. Boy, it's an expensive product. As a content creator, I use Adobe. Looking at the expected move, it's at 569 now. When we see these valuations, it's like, I know they're profitable. When we look at, let's just pull up Adobe here on Seeking Alpha. There is a special on Seeking Alpha, I should say. If you guys are patrons of mine, go and look at that email I sent out, because I think the sale ends today, but there's like a 40% discount right now for 4th of July, midsummer kind of special. So there is a discount code. I did post it on my Patreon at the beginning of the weekend, so just a couple of days ago. It is a free post. You can go over there, you can use the link, you can get the discount code. So if you're considering signing up for Seeking Alpha, total game changer for me. The quant rating is still a strong buy. This is where AI, is it smarter than us? And many times it is. So strong buy right now, rating 4.64, even though the valuation is high. A+ profitability in this. So year to date, the 1 year chart up 17%. Year to date still down 4.85%. This has been a big move. It's a big stock too. If you're buying 100 shares of 569, it's a $56,000 position. So, this is $1 million portfolio, still has 5.6% in Adobe if you have one lot of covered calls. Because of that, I think that many investors are not playing, covered call strategy on that. They're not even playing long share strategies. What they're doing instead is using spreads. So they're saying, okay, I'm bullish. The Seeking Alpha rating is strong. I'm looking out at August 2nd. I'm looking at a credit put spread, and I'm saying I'm risking $438 to make $70 probability of profit. So I can play this in a much smaller way by using a limited loss trade. If it completely tanks, if we do see a market sell off, we're only out $400. So that's the way to trade these types of trades for me and for many investors. What other questions do we have? Jackson says, thank you so much for your trade idea on IWM and TNA. I started weekly campaigns on both. Buy rate on Monday, let them expire on Friday. I don't roll. Whatever happens, happens. Awesome. So you're just letting them get called away. That can work if your fees aren't high. I mean, I'm not a fan of letting my stocks get called away. The reason for that is because of high fees. As a Canadian, we just get killed. IBKR is better, but in lots of accounts, I'm trying to avoid that assignment in most of the time. So I'm glad it's making money for you. That IWM is definitely has enough premium in it to trade those weekly. What I have done is I just have my shares and then I'm just selling either a weekly call against those. And I just perpetually have my shares, which has been great. It's amazing how much money it's making because there's so much premium weekly. So congrats. Let's fingers crossed it keeps going for all of us. Neil says, Mike, you might be interested in another trade strategy, the spaceship trade downside hedge. Ask Levi if you want to hear the thoughts on this trade. Yeah, absolutely, Neil. That is a great other potential trade. It is of 4 bear spreads with 10 bull spreads, typically on ES. So it's another form of like a 112. It just does have a limited loss and it has a max capped margin expansion in it, which is good for those of us, especially those of us who are not in the States and we don't have access to the low margin requirements that we see on like Tastyworks and even Thinkorswim in the States. Mike, that's your cue, Levi. Yes. So the spaceship trade, I have posts of it in my Discord, and it is a trade from Ron Bertino, great trader. I would love to see him make some more content. So Ron, if you're ever watching my videos, please, and I know you have, I know that we had some discussion after I released the Black Swan hedge trade, which is a variation of what Ron Bertino does. He's a fantastic trader, so you guys should check him out. And he doesn't have a lot of videos. That spaceship trade, you can find it on YouTube. It is a very old video, and it is packed with information that is very high level. Lots to learn from Ron. So big respect out to him for being a pioneer in complex option trading. Just space trip trade in YouTube. Yes, Terry said, oh, that's a lot better than what I did. So much to learn. Yeah, you're very welcome, Terry. I'm glad that is, I'm glad that was potentially helpful. The problem, of course, with trading, we're going back now to the Iron Condor discussion in the beginning. So if you're just joining now, talking about something we're talking about Terry's Starbucks Iron Condor, looking at those higher probability trades, we have to play out those numbers. And we will have losses. This is all part of it. So with Iron Condors, it's hard to, there's 2 schools of thought. Either put them on, hold them to expiration, or close them early. If we play short duration, just hold them to expiration. I am a firm believer in that. Anything that I put on that's less than 2 weeks, I fully expect I'm either taking max loss or max win. That's it. Because even on the last day, they can move quite a bit. We'll see what happens this week. Zeta say, a few weeks ago I asked about game. Okay, well, what did you? I don't usually talk about game. Let's talk about Chewy. Let's talk about game for a second. I'm not a huge fan of game. I don't like the meme stocks because when the problem with the meme stocks is that, and game in particular, when we see a move, when we see a move to the upside with these massive spikes that occur, this is, let's go to the 6-month chart here. So game trading along here, $10, and then all of a sudden it's at 45. It's actually really difficult to make money on this, even with spreads, just trying to get out of them. The volatility increases so much, it's actually difficult to get out. So I think if you're going to play these, you have to take that super risky, don't even trade it with a spread, trade it single-sided. If you think it's going to spike again, just buy a call and be prepared that is going to most likely go to 0. But if it goes up, great, you've made some money. Super hard bets for me. Chewy, though, is, now if you guys didn't hear the news, Roaring Kitty, who's like the GameStop pumper. I'm going to call him a pumper because that's what he did. And it pumps up some stuff. Nothing wrong with that. I have no problem with people pumping stocks. But what is his name? Something Gil something. I don't even know. Roaring Kitty, he goes by. He just bought 9 million shares in Chewy for $25. He's already down. Because the share was so large, he had to file with the SEC. So there was his position was like, what does that work out to? When you buy 9 million shares times $25, so he bought 225 million worth of Chewy for 25 something. I don't know if somebody could tell. Keith Gill, thanks, said, Zed Estate. He's down 2.75% already. So just today, So what is that? 2.99725, right? So he's already down like 7 million today. I don't know where it's going to go. Chewy is an interesting company. I've played it quite a few times, played it when it was higher than this, played it down at the bottom. Keith Gill is now a 6% owner in Chewy. If somebody wants to post the article, then that would be great if somebody could post that, because what's going to happen? I don't know. Is he going to pump it? Is it going to jump up? Is it going to go down? He's long, so he's assuming he's going to make some money. There'll be premium in that for sure. You have to pay for it somehow. And maybe he's just selling covered calls against it. Maybe he bought it and then sold covered calls against it that are in the money. So even if it drops, he makes money. Could be a really smart play. What was I going to look up? I was going to type in something here, and now I've forgotten. Kevin Schock is asking 6 delta strangle on gold futures. Yes, but if they move, be prepared to just take their max loss. I don't mind those 6 delta strangles at all, but earlier this year I took way too big a loss. I should have cut out like 100% loss on my strangles, so 200% of whatever my credit collected. So say you collect on a strangle, you collect $1,000. If it goes to a 2,000 valuation, I would get out. I held earlier this year and took like a $5,000 loss on 2 different positions. It was just silly. And then of course it came back in a range and would have been a winner. So have a good solid exit plan when you're trading gold strangles. It's a big multiplier and it does move pretty quickly. I actually don't play gold strangle. I play a short put with a 1-1-1 on the call side. That way, if there's a little bit of the move up, then I have a little bit of wiggle room to absorb, because gold tends to move up faster than it moves down. So I don't mind playing the short put on the downside, but I like to play the 1-1-1 on the top side. So that's kind of what's in my trading plan right now. I also play gold 1-1-2s. So I've got 1-1-2s, and then I've got naked puts with 1-1-1s on the call side. And that's all available in my Patreon. If you guys want to ask me what I'm trading, what you're looking at, I've got my trading plan there, and then I post those trades, and it's a very regimented weekly trade with like a maximum number of allocation. It's all percentage breakdown of how much my portfolio is broken down into each trading strategy, etc., etc. So welcome. I know there's tons of patrons on here. Shout out if you guys are patron already. Let me know in the chat. That would be great. What else do we have here? John Lindsay is asking, as far as dividends goes, I like some of the call strategies, JEPQ and SPYI. Right, totally. Those can be great, especially for investors that, if you have a plan that you're like, I'm going to just sell the at the money covered call all the time, you don't have to do anything. Just buy JEPQ. Or I actually am looking at those things. I'm not even familiar with either of those 2 symbols, but I'm familiar with the idea of covered call strategies. And why did I think JEPQ must be for NASDAQ? Because I'm thinking of JEPI, which would be the SPY, so JEPY, but JEPQ would be the covered call strategy on the ETF QQQ without actually having to do it. These make money in bullish markets. They don't in bearish markets. They usually slightly underperform the market if the market's going up too quickly. Very good long-term strategies. I have absolutely nothing against those. Jimmy Trader says, MTY. I'm having a hard time understanding that. MTY and Chewy trade. Oh my, you're just trying to say my Chewy trade went south because of that purchase. Oh yeah, that sucks. Sorry to hear that, because you had a call spread on, you had a bearish trade on. And this is one of the woes of stocks. Like, it's so fickle. It's like, it's like today it's up and then it's going to go back down. I hope that you've got enough time. I would assume that Chewy is actually going to come back down a little bit, but it's so hard to say. So I'm hoping you didn't lose too much. I hate when trades move against us quickly, especially when we got somebody just coming in and just like buying $225 million worth of stock, 6% of the company. Crazy. Sigrigi is asking, how would you play Tesla now? Thinking about a bear call credit spread. I don't know. Like recently with Tesla, this is where it's like, how do you guess these things? My position is still bullish, but my position is bullish based on this zone here in that like 250, 280 range. we were waiting for the announcement as to whether or not Elon's pay package was going to be announced and approved for the second time after it had already been approved. And then it had a unanimous 77% vote of shareholders voted for it. It didn't surprise me at all. I think that CEOs should get paid. I don't actually care if Elon Musk gets paid more than anybody else on the planet. Like, that's his prerogative. As a shareholder, as a long shareholder, I want to make money off the stock, and I didn't like when the stock was trading down so low. So I am happy for this move. I am still holding a slightly delta positive position, but it's not crazy high at this point. There's lots of premium in Tesla, so you can trade it pretty tight if you want. If we look at, let's look at the expected move here on Tesla, and let's see how far out the options pricing is before we hit 280. So it is right here. So that is October 18th. So that's the upper portion of the range. And the reason I use that is only because I'm looking at stock purchases from previous levels. I don't believe we're in this lower level anymore. My expectation is, as long as Tesla starts to make some money, we've got their Optimus robots and all of this stuff that they're working on. My assumption is that we're not going to come back down into this lower range below 200. So I am bullish above 200, and you can trade these as aggressively, as short term as you like. There are trades everywhere for Tesla. It's one of the most liquid traded positions we can have. So doing just like a credit put spread, July 12th, 10 days out, we could take these trades risking 208 to make 42, 77% probability. How do you play? I would be tempted to even trade some of these opposite. Like, if you did like a bearish trade on Tesla, and what if you just pulled this down here? Like, if you did this reverse of what options AI is, in this case, they're selling the 230 and they're buying the 235. I guess they would just do it as a put spread, wouldn't they? That's how options AI functions. No, how would they do it as a call spread here? Max gain 650, max risk 350. I mean, if we think that the stock is going to go up at all, over the next 2 weeks, there's massive potential here. Only 38% chance that it's going to make money, but 46% chance that you can double your money just by doing buying the long 225 and short the 235. So taking a bullish trade on Tesla. Obviously max risk $460. These are pretty good ways to leverage your funds if you're looking for low size trades. It's 11:52. I'm starting to peter out. Thanks for all the questions today. You guys are awesome. I love it. Tuesdays, I always get excited about doing these Tuesday trade sessions, because it's like amazing how we can just like pull up trade ideas repeatedly, really quickly, and with high probability of making money. And that's the whole goal, is to make money together. So let's take a couple other trades. SMH, I have traded SMH. I have not traded it lately. What's a trade idea? Why don't you guys tell me? What's a trade idea in SMH that I should look at? We'll take a look. Jimmy Trader said, I had a put spread on an expired trade, 2 times my credit. So not that much loss, but it offset my other 2 winners for the day. Exited, not expired. Oh, yeah. Okay, so you exited. Well, so it just offset. So that's good. So you didn't have like a totally wash day. Strangle and SMH. Love it. Easy money. Let's take a look. Strangle. SMH. You know what? I'm going to look at here on options AI, and we'll look at it as a condor, and then we'll just pretend that we don't have the long wings on. So if we did a neutral trade, condor, we're going to go out August 2nd, 30 days. Nice smooth curve. I don't think there's earnings here. SMH doesn't have earnings anyway, so what are we talking about? This is SMH's semiconductor So there's no earnings to worry about, which is great. There are companies that are reporting earnings in this time frame, but the expectation is that we're not going to move very far. Max risk 148, max gain 102, 70% probability of profit. That's the condor. Let's do it as let's just widen this out. What I'm going to do is I'm going to do a synthetic strangle. That's how far it's going to let us. $464 max gain. SMH is a $26,000 profit, so it needs to choose up a bunch of margin. Max risk $286 or $1,286. Max gain 464. See, this is me getting tired after an hour of talking. 73% probability of profit. That's a great little trade idea. $464 max risk 1286. By widening out these wings or not putting them on at all, we create a synthetic position, a synthetic strangle position. If there is a catastrophic event, it can be really good to have this on. Now, are we going to see catastrophic to the upside when we're already at all-time highs? I mean, it could happen, probably not likely. So if I was going to not trade something, one portion of this, it would be the long 297 call. I wouldn't buy that. But it is going to increase my margin requirement substantially compared to the margin requirement of only putting this in as a 1284. I like this trade. I'm going to put this on. I'm going to add this in here. So Iron Condor sell to open August 2nd. You're risking $1,282 to make 468 in a 17.5 wide spread. At expiration, you need the stock to be between 284 and 242. Options AI does this beautifully for us. It shows us that profitable range. And I'm going to just click submit. We'll put that into the order queue. Okay. Is there any other questions? That is it. That's all I've got for you because I'm gonna get on with my day. There's not much else going on. Sun is coming out. I'm gonna go for a bike ride and hopefully hit the pool. Hope you guys are having something fun to do this afternoon. Get some exercise in. Thanks so much, everybody. Let's get rich together. Take care. Bye.